Hello, welcome, and thank you for joining today's PENTalk. I'm Beth Parker with Pentegra. Before we begin, I want to go over a few housekeeping items. First, please find the control panel that's located on your screen. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you'll receive an email with a link to replay today's broadcast. If you would like a copy of the slide deck, you can download it now or at any point during the webinar. It can be found in the handout section of your control panel. We are joined today by Rich Rouser, Senior Vice President, Client Services. Rich joined Pentegra in 1997 and has traveled the country visiting over 1,000 clients. One of his favorite things is to share his knowledge on the importance of retirement savings strategies. Rich, thanks for presenting today and bringing us up to date on the latest legislation. I'll turn it over to you to get started.
Good afternoon, everyone. Thanks for joining today. We have another piece of new legislation to go over this afternoon or this morning, depending upon your time zone. This is the American Rescue Plan Act of 2021. This was signed into law recently by President Biden. It was kind of initiated in the House, went to the Senate, and literally just came out and is providing some additional stimulus relief due to the pandemic and due to COVID-19. So what I wanted to do first is just kind of go over some of the highlights here, right? I think one of the primary aspects of the new legislation is to provide relief for individuals, $1,400 for individual, up to $5,600 for families. So the way this piece of it is structured is somewhat different from what was done in the past. The bill, I shouldn't say the bill, the law, created funding for states and for vaccine distribution and management, rental assistance, housing vouchers, and other homeowner assistance. Again, another round of small business credits, airline payroll support, restaurant support is in this one, and some other relief for airports. Some enhanced unemployment benefits. That was another, I think, pretty big factor in this one, to again, provide some additional enhanced unemployment benefits. That piece of it is kind of interesting. There was a little bit of a back and forth on that between the House and the Senate. I think the House wanted to provide a supplement of $400 a week. The Senate basically countered with $300 a week, but in the end result, it is $300 a week. But they extended the amount of payments by one additional month, I think is the way it ended up. The other thing that's interesting on the unemployment benefits is they're exempting up to $10,200 from taxation for any unemployment received during 2020. So that was a little bit of a twist there. COBRA benefits is another interesting piece of it. They put some COBRA subsidies, and when I say subsidy, a pretty significant subsidy in for qualifying individuals. And this would essentially be in effect for the period April 1 of this year through September 30th, almost to Labor Day. And it provides for up to a 100% subsidy that I think the way I read the law is that the company providing, the health insurance plan, therefore the COBRA benefit, can actually get tax credits back for the amount of the subsidy. And that's 100% subsidy if they qualify. There's some pretty technical aspects of how that works. I'm not really going to go into that today. Ultimately, we're really going to drill down towards what's impacting retirement plans, qualified retirement plans. But I thought these were some of the noteworthy aspects of things that are in the bill. And obviously, retirement plan relief was in this, and that came in really a couple of different flavors, which we'll get into. Second thing I want to do today, other than the highlights, is just kind of recap the relief actions taken to date, right? So really it started back in March of last year. It's hard to believe that a year has gone by, with the pandemic here. But, the first round of it was the CARES Act. That was at the end of March of last year. It was about a $2.2 trillion cost. That included $1,200 stimulus checks, if you can recall, way back then. Then there was December of this year, just literally a couple of months ago. There was a $1 billion, almost a $1 trillion stimulus package, and that created stimulus checks of $600 for each individual. And here we are again in March of 2021 with ARP, the American Rescue Plan Act, almost a $2 trillion piece of legislation and $1,400 checks for individuals who qualify. The interesting thing on the qualification for this one is it phases out much more quickly than it did under the CARES Act. If you remember what happened under the CARES Act, there was a phase out that started at income of $150,000, and I think once your income got to $200,000, you were phased out of getting that stimulus check. Here, for an individual, the stimulus phases out within a $10,000 band. So between $150,000 and $160,000 of individual income, that phase out would be complete. And it varies, by the way, depending upon your status, whether you're head of household, things of that nature, some different levels and thresholds there. So a couple of things that didn't make it into the law. Again, we've been tracking this bill, at the House level and looked at a number of provisions along the way. It was questionable whether or not some of them were going to make it into the final version of the law. So and I think these are noteworthy. The increase in the minimum wage was in the original House bill, and that was pushing minimum wage up to the $15 per hour level. I definitely recall there was going to be a phase in of how that was going to work. It wasn't necessarily going to be all at once, but there was, that was actually determined, I think, by a judiciary representative in the Senate that they couldn't even consider that because of the way it was being presented. It wasn't appropriate to be presented in this body of legislation. So that was, the Senate wasn't even technically able to weigh in on it, so to speak, the way it fell out. The original House bill had retirement plan cost of living adjustment freezes. And we were very, very concerned about that aspect. And the freezes would have meant, the indexed or inflation indexed increases in eligible compensation, right, for qualified plan utilization. The increase in benefit limits over time, right, whether it's the 401k salary deferral threshold max, whether it was the catch-up contribution maximums, right, those are all indexed. Overall defined contribution benefit or contribution limits are also indexed over time, inflation indexed. So, and also on the defined benefit side, maximum benefit, obviously salary limits there would have been impacted. So again, we were very, very concerned about that because that would obviously have a negative impact on retirement plan participants and retirement plans in general. That ended up falling out of the final bill. I think it was Senator Schumer who actually presented an alternative to that, and basically he was in favor of removing that, this cost of living adjustment freeze. And the trade-off, I think, was some sort of a tax deduction cap on executive comp, which I'm not going to go into today. That really isn't the tone of where we're going. But again, it was interesting to see what happened there. The third thing that I wanted to put on the table is, and I'm a little bit surprised, right? If you remember the original CARES Act legislation, there was relief, flexibility to tap into retirement balances and 401k plans by participants in the original CARES Act, right? There were CARES Act loans, right, which increased the max loan limit under a qualified plan if you were a qualifying individual. There were CARES Act loan extensions where you could either skip payments for up to a year and even add up to a year of repayment terms to your loan. And there were also CARES Act distributions. So those optional, right, they were optional to be adopted at the plan sponsor level, optional and voluntary, I should say. They expired. One of them expired September 22nd of last year. The other one effectively expired December 30th. So participants did not avail themselves of those flexibilities. Those things have not been renewed. Some of you might be thinking, well, wait a second, wasn't there something in the legislation in December that talked about, right, these types of loans and distributions? The answer is that yes, there was. But the way they wrote that is it didn't apply to the pandemic, right? They basically codified the fact that these types of flexibilities could be added in the future if there's another quote-unquote national disaster. As a matter of fact, the only one that really I think would qualify are the California wildfires. And maybe another one that I'm not thinking about, maybe the Louisiana area. But I think that it certainly did not go back retroactive and address the pandemic or COVID-19 impacted individuals or families. So I found it interesting. It wasn't extended more broadly to people impacted by the pandemic. So, and by the way, this third bullet wasn't really contemplated even in the House bill. I just put it out there because I find it interesting that they didn't deal with that. So I thought I would break down the new law by a variety of segments. These are the major categories of relief that are being provided by the new law, and this is an indication of how many billions, literally billions of dollars they're spending or allowing us to spend on various categories. So, I know the popular press kind of, actually, let me go to the next slide. I did it here as a percentage of the total cost, right? As I mentioned before, the total cost of this law is about 1.9, almost $2 trillion. So if you look at COVID-19, right, second category here is maybe about 7% of the spending. And I think a lot of the popular press has said, well, hey, the whole bill is only spending 7% of the total on COVID-19. I don't really think that's a proper interpretation of it. Again, if I look at these other categories, extended unemployment benefits account for 12 or 13% of the total. Expanded tax credits, right, for employers who are struggling through the pandemic. That's another 7%. Pick on health. There's relief. I shouldn't say relief. There's money in here to help the vaccination process, right, and to help with distribution and to help plan, quite honestly, for future needs in terms of vaccinations. Stimulus checks, single biggest category. It's over 20% of the total. So, there's some oddball things in here. There's transportation, and I know two pieces of that were knocked out in the final. I think the Bay Area, I think it's called the Bay Area Rapid Transit System. There was some funding in it for that, and there was also funding initially in it for a bridge, some sort of a bridge in upstate New York. Those two pieces of stimulus were knocked out of this. But again, restaurant is $25 billion being made available to restaurants who are struggling due to the pandemic. Same thing with small business. So I kind of argue with how it's been portrayed in the popular press. I think there is quite a bit here that is certainly adding to individual relief, and that's the single biggest thing in those stimulus checks. But again, there are many, many other sectors that are positively impacted by this that should help significantly, I think, in terms of supporting the economy. Let's put it that way. So now we're going to dig into retirement plan relief, and by and large, hope nobody's disappointed, but the relief that we've seen is really all with respect to defined benefit pension plan relief. And that came in two flavors, right? Single employer plan relief as well as multi-employer plan relief. Just to be crystal clear, multi-employer plans, those are typically union type plans, right? And as an industry or as a grouping, multi-employer plans tend to have severe underfunding problems, much more so than the private sector plans. So I'm going to go through this two different ways. We're going to focus primarily on single employer defined benefit plans. I'll mention towards the end some of the multi-employer plan relief and community newspaper relief that is also available. So one big thing they did for defined benefit plans is extend the amortization period. So just simplistically, actually before I get to the site, simplistically, the unfunded portions of a defined benefit plan under prior law, I should say, were amortized over a period of 7 years. So each time, year by year, this gain or loss is, I'll keep it simple, an amortization-based setup, amortized over 7 future periods, to kind of smooth out the impact and the funding impact on a defined benefit plan. So number one, there's an extension of that, which I'll get into in a minute. Second thing that was done, and this sounds complicated, it really isn't though, an extension of pension funding stabilization percentages. Simplistically, I'll go through an example or two. Basically, it's going to provide for higher interest rates, right, in terms of valuing defined benefit plan liabilities. So the higher the rate, the lower the liability. The lower the liability, the less funding an employer has to do with respect to their plan. And as I mentioned earlier, in the final version, final law, there was no impact on defined contribution plans, and all of those freezes, right, of cost of living indexed increases were off the table in the final version, final law. So in single employer plans, I mentioned the amortization period is changed. It's no longer 7 years, it's 15 years. And if you do some quick math on that, it basically can reduce the amortization payment on the unfunded by up to 50%, is kind of the quick math on that. And again, the way it works, simplistically, any of the amortization bases that were set up, they all get wiped out. A new number gets set for the unfunded, and it starts to run out on a 15-year amortization period. So generally speaking, the way the law is written applies to plan years beginning after 2021. However, they put some options in there for plan sponsors. They said, hey, you could actually adopt it retroactive to the 2018 plan year, 2019, or 2020 plan year. So realistically, I don't know. I think about 2018. I'm not sure many employers are going to go back and adopt it then. I think the only way you would do that, I've thought about this a couple of ways. I guess you could have an oddball plan year that begins December 31 and ends December 30th of 2019. But even that year would have been closed already, right, with respect to 5,500 filings, so on and so forth. But I guess if I had a funding deficiency for that year, if I couldn't afford to fund the plan, arguably I could probably go back and apply some of these new metrics, reduce my funding obligation, and potentially decrease an excise tax I might be otherwise subject to. So that's the only reason I could see somebody going back that far. Almost the same thing for 2019. 2020, though, some of the valuation work, actuarial work, has not been done on some plans for that period yet. So absolutely, I could see employers adopting it at that point in time. We run here at PENTalk a number of quite a few defined benefit plans. Most of them are single employer plan, calendar year plans, but we have all sorts of plan years. So for single employer plans, we're going to be looking at working with each client, right, in terms of what are their needs and how do they want it to work, so on and so forth. We also run a very, very large multiple employer defined benefit plan with the July 1 through June 30th date. So for that one, we're going to talk to the board. We actually have a board meeting in a couple of weeks, and we're going to talk about the strategies we have there. More than likely, we're going to use these provisions effective July 1, 2021 for that period. Not sure we're going to go back or have a need to really go back to July 1, 2020 for that one. So again, that's a discussion with that board of directors. And also, discussions with individual plan sponsors as to when they want to have that apply. So the other thing, again, this is actually pretty simple. A lot of people make defined benefit plans sound tremendously complex. They're not really that complex. So pension funding, there's this concept called interest rate corridor and smooth interest rates. And the law is basically saying, look, we're going to have some interest rate stabilization. And in English, I alluded to it earlier, effectively what they're doing is saying we can use a higher interest rate than would otherwise have been allowable under the, I should say the immediately prior law. And, our assessment of that is, I think for 2021, we're going to end up using rates that are very comparable to what we had back in 2019. And, quite honestly, between 2019 and certainly earlier this year, rates have just continued to go down, down, down. and obviously lower rates increase pension liability. So really what's going to happen is this law is going to effectively reverse the trend and basically put us back to where we were a couple of years ago. Clearly, we haven't had time to do a full assessment of the impact here, but our initial thinking is that these higher rates are going to enable us to use rates that are high enough that plan liabilities are probably going to decrease, we think, by probably at least 4%, if not 5, 6, or 7%. So when I think about the impact of these two things, right, the longer amortization period, which in and of itself could reduce, the funding on that amortization by up to 50% is my quick math on that. This could reduce liabilities by 5, 6, 7% maybe, which again will have a pretty material impact, right, on reducing the cost of funding a defined benefit plan. Now, I think it's important to note. Well, hang on. Let me just get through a couple of things. For those of you who are super technical, here's what the numbers look like. Here's what the corridors look like. Here's what they were from 2012 to 2019. It was a range of 90 to 100%. You can see they're tightening it up under this new law to 95 to 105%. Then it kind of phases. This is how the old law worked. It kind of phased to a wider corridor. But the bottom line real impact is we can use higher interest rates to reduce plan liabilities. The other interest, I find it interesting, is, well, hang on, a couple more things. 5% floor on the 25-year average rates. And again, there's flexibility in terms of how this thing is elected at the adopting employer. By and large, it's effective. You can elect not to have it applied to plan years before 2022. But again, there's flexibility to adopt it, for a couple of different beginning periods. The other thing is there's a rather arcane, shouldn't say arcane, but it's in the law, that says if your plan's funded ratio is below 80%, or if it's below 60%, there are restrictions. For example, if your plan has a lump sum feature. If it's below 80%, you start to get restrictions on lump sum benefit payments. If it's below 60%, you're required to actually hard freeze accruals of benefits. So you can choose to use this flexibility, right, with respect to everything other than the funded status for those benefit restrictions. So again, another, I think, thoughtful thing to do, because the last thing you want to do as a plan sponsor is underfund your plan, continue to maybe permit people to take lump sums that further drain assets out of the plan. I shouldn't say it's the last thing, but the point is you may want that flexibility to say, let's not continue to dramatically underfund, right? The whole point of this relief is to, it realizes that plan sponsors are under stress. It realizes they may not be able to afford it in these pandemic times, right, due to negative impacts on their business. The whole intent is to try to, A, help the business, B, help you maintain your workforce and help employees stay employed is the point. Again, the relief is there. It's flexible. Part of it's retroactive, which I think is kind of cool. And it's not mandated, right? You don't have to do this, but realize that to the extent that you take advantage of it, you're kind of kicking the unfunded can further down the road, but it's all under the heading of flexibility. So I'm not really going to talk, by the way, about this next slide, but I put it out there. It's in the reference material. If you do work with or part of a multi-employer, typically a union plan, or a community newspaper plan, right, there were some additional relief metrics put into the new law. Again, I'm not really going to spend time on that. And I think we're actually, I just have a couple of more quick comments here. Late breaking news, this I think came out last night, but I'm sure everybody on this call has already heard about this. But the IRS has changed your personal tax filing deadline to May 17th. They did something similar last year. Last year it was extended, I think, till June 15th was the date last year. But that, we saw that come across last night, and I figured let me at least comment on it here. The only other thing I wanted to really talk about today is there was some proposed legislation last year the Securing a Strong Retirement Act. I call it SSRA. Everybody else in the world calls it Secure, meaning Secure Act 2.0. We did some webinar on this a while ago and commented on this a while ago, but we keep getting questions on, do we think that's going to be enacted? And by the way, just to refresh everybody, right, there are something like 34 provisions in that proposed bill, right, that, and quite honestly, every single one of them was a good thing for the retirement plan industry. Things like increasing catch-up contributions for individuals 60 and older, pushing the required minimum distribution date, RMD date, from age 72, right? Remember that was pushed up last year or the year before in the Secure Act, but also pushing that out to age 75, for example. A whole bunch of things that would, increase tax credits for employers establishing a 401k plan or a retirement plan, a whole bunch of really, really good stuff. The comments we had, when that first was floated around is lots of good stuff, but it costs a lot of money. Because the point is, to the extent that you're delaying receipt of taxable distributions, that means less revenue in the near term for the government, right? To the extent that you're increasing the ability to do catch-up contributions at the individual level, again, to the extent those are pre-tax contributions, the government receives less revenue. So I can't say definitively if and when any of those features are going to be adopted, but it is very possible under the new administration that more and more of these things may make it into a law or maybe attached to some pieces of other laws that may be passed. So with that, I know we're very close to time. Beth, I don't know if we have time for a few questions.
Let's try and get in one or two before we end at 2:30. This one pertains to one of your opening slides. Are the enhanced unemployment benefits tax-free?
Yeah, I think the way they did that is they exempted up to $10,200. Well, I think it's really the $10,200 for last year that they made tax-free. So that's kind of, my takeaway in terms of the tax-free element. Was there another question?
Yes. Are there any other retirement plan changes likely to happen in the near term or later this year?
Yeah, that probably came in just before I kind of jumped into the SSRA. Yeah. I mean, I obviously don't see anything pending right now, but it is very, very possible we're going to see some other things during the course of 2021. I almost anticipate this year to be busier than last year, which was an incredibly busy year from a legislative and a regulatory standpoint. So I definitely expect much more to come.
All right, very good. Well, I want to thank you, Rich, for bringing us up to date and for the audience for joining today. And we'll give you 1 minute back in your day. Thank you for joining.
Thank you, everyone.